which is being hosted under the aegis of Investor Education and Protection Fund of the Ministry of Corporate Affairs, Government of India. This program is being organized by the Committee on Capital Market and Investors Protection ICAI, and this is being hosted by the Ernakulam branch of SIRC of ICAI. The chief guest for the day is Sri Gulab Chand Yadav, who is the Registrar of Companies, Kerala. And there are two speakers for the day. First one is Dr. VK Vijay Kumar, the Chief Investment Strategist of Geojit Financial Services. And he will be talking to us on capital market, financial planning, and wealth management, Indian and global economy. The second speaker is a member of the Institute of Chartered Accountants of India, Sri Rupee Rajagopal from Kochi. He is going to talk to us on investment opportunities for small investors, along with some do's and don'ts. With these words, may I request the chairman of Ernakulam branch of the Institute of Chartered Accountants of India, C.A. Ranjit R. Warrior, for his welcome address. Over to you, Ranjit.
Thank you, Deepa, for this brief introduction. A very, very good evening to all of you. Most respected faculty members, very learned members, I must say. Dr. Vijay Kumar, sir. He's been an expert, I would say, an eminent personality, very down-to-earth person. Plus with immense control on the topic. He's been in this forum or arena for long years now, and hence is the grip that he has on this particular topic. And we also have our very own chartered accountant member, CA Rupesh Rajagopal ji, Vice President of DCB Bank, who's also been with us whenever we plan for an investor awareness program or anything related with a bank session. Rupesh ji is the first person probably that we all go to, considering the expertise and experience that he has working with DCB and several other banks as well. Vijay Kumar ji will be handling the first session today, though the topic probably looks a little too broad, if I might say, but I'm sure he's going to be very specific on the areas that he's going to talk to us on about because of the effectiveness and the importance that he sees and all of us sees with this investor awareness program. And our chief guest for the day, Registrar of Companies Yadav ji, is expected to join by 5 o'clock or so. So probably we'll have a brief inaugural address of his after the first session of Vijay Kumar ji. With no much ado, let me straight away request and go into Vijay Kumar's session. I'm sure it is going to be very, very effective, and all of us are eagerly waiting to hear from him. Over to Deepa for a brief intro on Vijay Kumar ji.
Thank you, Chairman. A highly respected figure in the academic circles in Kerala, Dr. Vijay Kumar joined Geojit Financial Services in 2010, prior to which he was working for Sri Krishna College, Guruvayur, as a professor and head of the Department of Economics. Dr. Vijay Kumar has a MA and a PhD in economics from Calicut University. Dr. Vijay Kumar is known for his articles on economic issues, which regularly appears in the print media. He is active in discussions on economic issues in TV channels, and he regularly addresses investor meets organized by the company and offers investment advice to both new and savvy investors. As a chief investment strategist for Geojit Financial Services, Dr. Vijay Kumar speaks on topics related to capital market, financial planning, and wealth management, Indian and global economy, central banking, monetary policy, fiscal policy, the budget, etc. He has presented many papers and delivered many lectures on the capital market in the national and international seminars. His paper, Financial Innovations, Booms and Disasters, was judged the best paper in international conference held in Loyola College, Chennai in January 2009. He is also a certified trainer from the UTI Institute of Capital Markets. Dr. Vijay Kumar has so far written 4 books on economics, published 200 plus articles, and presented various papers in international seminars as well as national seminars. Dr. Vijay Kumar, over to you, sir. We are eagerly waiting to hear from you. Thank you.
Thank you, Deepa, for that introduction. Good evening to all the participants. Ranjit, the chairman, and all the members of the committee, and all the participants, a very good evening to all of you. Ranjit, somebody is presenting the slides for me there, no?
Yes, sir.
Okay.
Yeah.
Okay. So I'm very glad to be with all of you this evening, even though virtually. I prefer to talk to a physical audience. I enjoy looking at the face of the audience, the participants, and speaking. I enjoy doing that. But today we are living in a new normal, and this new normal, virtual reality is the reality. So till we reach the old normal, where we can travel and attend the conferences and the meetings physically, let us compromise with this virtual reality. So my presentation, even though the topic given is a very exhaustive one, um, I don't think I can do justice by talking to you on financial planning, wealth management, Indian economy, global economy, all within 1 hour, 10 minutes. Therefore, I will confine myself to investment, because this is an investment awareness program. So this is more, my focus will be more on investment issues. And towards the end of my presentation, I will be looking more exhaustively in detail on the Indian economy as well as the global economy, the present market scenario. Why do we have the market economy disconnect when the economies have been slowing down last year in one of the worst recessions in human history? The stock markets globally have been shooting up. So why this market economy disconnect? What are the economic reasons for that? How do we explain that? All this I will explain in some detail towards the end of my presentation. So since we are already 12 minutes into the program, and you have the chief guest joining by around 5 o'clock, without wasting much time, let me straight away get into the presentation. As you can see, my presentation is structured like this. You start by, even though I'm addressing an august audience of experts in finance, I still will start with the basics of savings, investments, and wealth management. Some of you might find it elementary, but then it is important to start with a very strong base. From there, we move on to investors' expectations, what investors expect when they invest their money in various asset classes, be it bank deposits or gold or mutual funds or stocks or bonds or public provident funds, national savings certificates, whatever might be the asset class, what investors expect when they make investment. From there, we move on to the various asset classes normally available to ordinary people. What are the various asset classes? And the risk return profile of these various asset classes. We know risk and return are positively correlated. The higher the risk, higher will be the return. So we'll be looking at the risk return profile of various asset classes. Then I move into your territory. Since it is your territory, I don't think I will have to explain in detail the tax implications of investment. What are the tax implications for investments in equities, mutual funds, equity mutual funds, hybrid funds, debt funds, etc. Then we'll move to the changing investment landscape in India. People of my generation, only a very small minority of my generation invested in stocks. But now we are living at a time when there is an explosion in investments in stocks, not just in India, all over the world. The so-called Robin Hood phenomenon, I'm sure you would have heard about this Robin Hood phenomenon, a platform in the US where retail investors can trade from anywhere using the platform, and there is no charge on buying and selling of shares. If at all there are some charges, the charges are very, very negligible. So a large number of youngsters, and youngsters today are very, very tech savvy guys, unlike people of my generation. So in India, during the last 1 year, the number of new demat accounts that have been opened are a record, a huge record, beating the previous record by a wide margin. So large number of new demat accounts are being opened, almost 1 crore during the last 1 year, new demat accounts opened. Similarly, new systematic investment plan, SIP accounts in mutual funds. So we are looking at the changing investment landscape as well as the changing profile of investors in India today. Then I will go to the concluding part, which I will explain in some detail because most of the participants who are investors will be keen to know what is the current scenario, of why the markets are high, is there a risk of a very sharp correction in the market, what about valuations, and what should be the ideal investment opportunity. This will be the structure of my presentation. So let us move to the next slide and start with the basics. As we all know, this saving is the balance in income after meeting expenses. Your income is 25,000 rupees, your expense is 20,000 rupees. So 25 minus 20,000, 5,000 is your saving. Simple, elementary school economics. But what is investment? Investment is deploying money for a return or profit. Whatever money you have, you are deploying. And what is the objective of that deployment of money? That is to generate a return on your money and to generate a profit. That is why it is called investment. So these two concepts are very familiar, but the concept of wealth is slightly different. Wealth is important because we have to understand the nature of wealth creation. So what is wealth? Wealth can be defined as an abundant, valuable possession. Valuable possession is not wealth. If you have, let us say, 2 lakhs rupees in a bank account, FD, that is not wealth. If you have, let us say, 40 sovereigns of gold, even though it can be good, it cannot be regarded as wealth because it is not ample. But if you have investment, whatever it might be, it can be bank deposits, it can be gold, and if it goes into crores of rupees in value, then it is called wealth. And that is why we say Jeff Bezos or Elon Musk, they are changing places 1 and 2 as the richest people in the world. And the richest people are classified on the basis of the wealth. And wealth today is the market capitalization of the shares which they own, right? If Elon Musk, the value of the shares of Elon Musk that he holds in Tesla is $130 billion, then that means that is his wealth, right? So wealth is abundant, valuable possession. Some valuable possession in abundance, that is wealth. And the last 100, 150 years of financial history tells us that wealth is created through systematic, disciplined investment over a long period of time. Please read that last sentence in the slide in green. Wealth is not earned, it is created. This is very, very important. This one sentence, if you have not given much thought to that, think about that. When I used to teach students economics, I used to tell them this, the difference between income and wealth. Income is earned. You work and earn your income. Whatever you are, you may be an agricultural laborer working in the paddy fields. You may be a street seller selling commodities on the street. You may be a school teacher, a college professor, a chartered accountant, a cost accountant, a banker, a doctor, whatever. You work and earn your income. So that is your income. And that income is earned by working. Wealth is not earned by working. Wealth is created through investment. And this is very important. Wealth is created through investment. Investment over a long period of time. There are a large number of examples. I will give you the classic example. Some of you must be familiar, perhaps all of you must be familiar with that. But if you have not heard this example, you will find it very difficult to believe. Infosys, India's iconic IT company, came out with their IPO in 1993. Initial public offering of shares was in 1993. And one share was issued at 95 rupee, 85 rupee premium plus 10 rupee face value, 95. And all the applicants who applied for the shares got allotment because the issue was undersubscribed. So something very interesting. Because at that point of time, nobody knew that this was going to be a massive wealth creator. Even the promoters of the company like Narayana Murthy, Nandan Nilekani, Chris Gopalakrishnan, they didn't have any idea of how much wealth their startup was going to generate. So imagine a person who applied for 100 shares in Infosys in 1993. And imagine another person who deposited 9,500 rupees in a bank as a fixed deposit in 1993. Further imagine both these people. A is selling all the shares of Infosys which he has in his portfolio, and B is redeeming his fixed deposit today that he made in 1993. 9,500 rupees fixed deposit will be around, let's say, all the accumulated interest will be close to less than 2 lakhs of rupees. Whereas if the investor A who invested in 100 shares of Infosys in 1993, if he sells today, if he sold today at any point of time, I know the closing price, he will be getting how much? He will be getting, hold your breath if you do not know this, 14 crores of rupees. Because the original 100 shares are now more than 1 lakh shares through bonus issue of shares and share split, stock split. So 9,500 has become 14 crores of rupees. This is wealth creation. Infosys is a classic story. Globally, there are a large number of stories like that. Amazon, Microsoft, Netflix, Google, Facebook. Even the employees have become multi-millionaires because they have been given stock option by the promoters when they joined the company. So many of them in their 30s are multi-millionaires. In India also, apart from Infosys, many other companies like Kotak Mahindra Bank, HDFC Bank, HDFC, Asian Paints, all these companies have created phenomenal wealth for investors. Because the stock market provides a platform, an opportunity for ordinary investors to participate in this wealth creation. So that way, this is stock market actually encourages inclusive growth because it enables ordinary people to participate in this. Let me give my own example. I've been teaching in the college for 32 years. I joined Geojit only after my retirement in 2010. But I've been investing in the market from 1985 onwards. When I started investing in the market, the Sensex was 430. Now it is above 50,000. That means it has multiplied more than 100 times. Now, I am an academic. I'm not an entrepreneur. I don't have any enterprise in me. I'm only an academic, but I have been an investor. And when I invest, when I invest in stocks like, let us say, HDFC Bank, HDFC, Kotak Mahindra Bank, Hindustan Unilever, Infosys, even in Kerala companies like Geojit, Manappuram Finance, V-Guard, I am becoming an owner in all these companies, right? So a shareholder is an owner in all these companies. So when these companies, India's great companies like these, which I mentioned, Larsen & Toubro, many companies like that, when these companies grow, when the stock prices appreciate, I also benefit from that. I'm not a businessman, I'm not an entrepreneur, but I am participating in this wealth creation through my investment. I took some time to explain this because I was driving home this particular point. Income is earned, wealth is not earned, wealth is created. Anybody can create wealth. That is my argument from my experience. Anybody can create wealth. You have to participate in that wealth creation. By working and earning an income, there is a limit beyond which you cannot make money. Of course, if you are a highly paid professional, you can make money, but there are highly paid professionals are only a minuscule minority. But even ordinary people can create wealth through investment if they are disciplined investors. Mr. Rukesh Rajagopal must be telling you about the large number of do's and don'ts for retail investors. Who will tell you? He will tell you that investors will lose money also if they make the wrong kind of decisions. But if you make the right kind of decisions and remain an investor without speculating and trading in the market recklessly, 99% you will make big money. That requires time. So I took some time to explain this because it is important to understand this distinction between earning income and creating wealth. Now, this couple of slides I will quickly pass on because these are fundamentals. Why do we save and invest? Number one, you have to save and invest money to beat inflation. If your bank is giving you 5% interest on your deposit, and if the inflation in the economy is 5%, your real return is zero, because real return is nominal return minus inflation. So bank interest is 5%, CPI inflation is 5%, so your real return is zero. So you have to get positive return on your investment, you have to beat inflation, and to beat inflation, you have to invest your money in assets which can beat inflation. Second, you have to invest money to make your money grow. All of us want to make our money grow. And all of us have many desires in life, like acquiring a house of your own, acquiring a vehicle like a car. Then for travel in vacation, abroad is a major within the country, and also abroad is a major and priority of youngsters, particularly people of this generation, unlike my generation, of which very few people ventured on vacation outside. But things are changing. The children's education is very expensive these days, professional education. And marriage also, particularly, I don't like to say this, but then unfortunately, marriage of weddings of daughters is a very expensive affair because of our cultural issues. So for that also you need money. Then finally, you have to plan for retirement. That also is a very important financial goal. Only 14% of Indians are working in the organized sector, and only 14% have retirement savings or pension from the government or the company for which they work. The rest 86% do not have pensions post-retirement. Therefore, it is very important, particularly for the youngsters now, to plan for their retirement. And finally, all of us have the desire to pass on the wealth that we created to the next generation when you transit from this world to the other world. So this is what we expect from investment. And next slide, please. Let us go to the next one. Now, for ordinary people, these are the important asset classes available for investment. Does not require much explanation. You know this. What are bank deposits, equities, bonds and debentures? Both are the same. Fixed income instruments, interest-bearing instruments. In the developed countries, they call it bonds, but in India, fixed income instruments issued by the government and public sector undertakings are called bonds, and those fixed income debt instruments that are issued by the private sector are called debentures. Then we have mutual funds. There are different categories of mutual funds: equity funds, hybrid funds, tax planning funds, contrarian funds, debt funds, lots of categories. Then there are insurance products. And insurance is one sector which has got transformed beyond recognition after the entry of private players and also foreign players. In the latest budget, foreign insurance companies have been allowed 74% equity participation. So this is an industry which is growing and an exponential pace, and also innovative products are being introduced by the different players. And finally, REITs and InvITs are there. This is a new product which only a small minority of experts know. REITs are real estate investment trusts, and InvITs are infrastructure investment trusts. These are the important asset classes available for investment. The last category, only HNI investors, a very small minority of investors have invested into that. Now let us go into the next slide, which shows the risk return profile of various asset classes. This also I will quickly go through because again you are familiar with that. Let us take bank fixed deposits first. Bank fixed deposits now give you around 4.8% return. The risk in bank deposits is very low because banks seldom go bankrupt. Of course, banks fail. In India, we have many even recent examples of banks going bankrupt, like Yes Bank and Lakshmi Vilas Bank. Some recent instances where banks actually went bankrupt. But then in India, for safeguarding the interest of depositors, whenever a bank becomes a bankrupt basket case, the government steps in, the RBI steps in and merge the weak bank with a strong bank, weakening the strong bank in the process. So therefore, that's why I said the risk of depositing money in a bank is very low, but theoretically you have insurance on your deposit only up to 5 lakhs of rupees, not more than that. So theoretically, if your investment is more than 5 lakhs, and if the bank goes bankrupt, there is the probability of you losing money. In the developed countries, it happens. When banks fail, the depositors lose money, but not in India. That's why the interest is, the risk is very low. There is no diversification when you're putting your money in bank deposit. There is no diversification. Now, what do I mean by diversification? For example, if you are investing in an equity mutual fund, a large cap fund. If you take a large cap fund, like for example, ICICI Prudential Blue Chip Fund or HDFC Top 100 Fund. Now, if you look at the portfolio, you will find companies like Infosys, TCS in the IT segment, HUL, ITC, Godrej Consumer from the fast-moving consumer segment, Larsen and Toubro, V-Guard, companies like that from the engineering segment, industrials. You'll find HDFC Bank, Kotak Bank from the banking segment. You'll find HDFC Insurance, HDFC AMCs. This is from the financial services segment. You'll find Bajaj Financial Service or Bajaj Finance from the finance space. You'll find companies like Muthoot, Manappuram, for instance, from the gold loan companies. You'll find shares like Maruti, Bajaj Auto, Hero Motors Corporation, Eicher Motors from the automobiles. So all these different industries are represented in that mutual fund industry. Therefore, you have the benefit of diversification. On the other hand, if you are investing in a product like gold only, or investing only in bank fixed deposit, the benefit of diversification is not available. Then capital appreciation, if you are withdrawing your interest on the fixed deposit every month, there is no capital appreciation. There is no tax benefit on your fixed deposit unless you are locking in your money for 5 years under the ATC benefit with which you are familiar. There are no tax advantages. Coming to post office bank deposits, the interest was high. Now it has come down. It has again come down from this level. But the risk is very low because there is a government sovereign guarantee on this. There is no diversification, no capital appreciation, again taxable. Coming to public provident fund, again the rate of return is around 7%. The risk is nil because of the sovereign guarantee, no diversification, no capital appreciation. But then in the public provident fund, there is a tax exemption. It comes under EEE, exempt when you put money under ATC. Of course, there are maximum limits now. In this budget particularly, there is some tweaking regarding that. Then when the interest is accrued, again, there is no taxation. And when finally, after the lock-in of 15 years, if you redeem the money under PPF, there is again, there is no taxation. From the tax perspective, public provident fund is very attractive. If you're investing in mutual funds, for example, if you are investing in equity mutual funds, in debt mutual funds, you will be getting lower return. Historically, you will get 15. If you have 15 is slightly on the higher side. I've taken 15 because that is the average return from investment in the stock market if you take the last 41 years in India. For instance, in 1979, the Bombay Sensex, Bombay Sensitive Index, what we call the Sensex was 100. Of course, Sensex came into existence only in 1986, January. But the base year is 1979, and 1979 Sensex was 100. Now it is 50,000, above 50,000, around 50,000. So that means Sensex has multiplied 500 times. The 500 times multiplication is more than 15% appreciation during the last 41 years. So this is historical, but then even 10% return is very good under the circumstances. So if you are investing in equity mutual funds, you will get around this kind of returns. If you are investing in unit-linked insurance plans, you can expect to get 8 to 10, 12% returns. And regarding capital appreciation, there is very high probability of capital appreciation in equity mutual funds, ULIPs, as well as in stocks. Now, I will come to this. I'm not going into detail because you guys, as chartered accountants, practicing chartered accountants, know about this tax dimension much more than I do. Therefore, there is no need to teach grandma how to suck eggs. So let me go to the next part, please. So as I have already, next slide, please. So as I have already explained, the basic principle of investment is, the fundamental principle is, don't put all your eggs in one basket, right? This is the cardinal principle for ordinary investors, right? Not for extraordinarily talented investors, not for people like Warren Buffett or Peter Lynch or Rakesh Jhunjhunwala. No. For them, they break this rule. They will say, put all your eggs in one basket and take care of that. That is conventional economic thinking. For people like Rakesh Jhunjhunwala, all their wealth is in stocks. For Charlie Munger and Warren Buffett, their principle is put all your eggs in one basket because they are exceptionally talented investors. Warren Buffett is the fourth or fifth richest man in the world, and he made all the money from investment in stocks. But then we are not like Rakesh Jhunjhunwala or Warren Buffett or Charlie Munger. We are ordinary people. Therefore, we should not put all our eggs in one basket. We have to diversify investment across asset classes. That means, in simple language, we should invest money in bank deposits, in equity, debt, in gold, and also in gold today we have options. You need not stick to what John Maynard Keynes, the economist, called the arrogant yellow metal, the jewelry. You can invest in gold ETFs, you can invest in gold bonds. Then there are avenues for investments in real estate. And today you can invest in real estate through REITs, real estate investment trust. Right? You need not have very deep pockets to buy a property in Bangalore. You can invest through real estate investment trusts. Real estate investment trusts are just like mutual funds. They pool money from investors and buy commercial property. And when the value of the commercial property goes up, the NAV of REITs will go up, and whatever dividend they receive from the commercial property, they distribute as dividend. These are things which you know. So invest in various assets based on your goals and the risk appetite. One question which the people ask me whenever I address investor conferences, a common question is, how much should I invest in stocks, right? So the standard answer to this question is, we say, most financial planners say, 100 minus your age is the amount of money that you should be investing in stocks. 100 minus your age. So if you are 30 years of age, 100 minus 30 is 70. That means invest 70% of your investment funds, investable funds, in stocks. Because you are young, your risk appetite is very high, and you have a long time horizon. Right? On the other hand, if you are 60, you have already retired or about to retire, 100 minus 60 is 40. So you should be investing only 40%, even less than that, in stocks, because your investment horizon is very low. And this is not the time in your life where you should be taking risk with the money. That is a general principle again, but let me tell you, this rule also can be broken, right? It is not valid. I've just completed 65. So according to this principle, I should be deploying only 35% of my investable funds in stocks. But for me, more than 90% of my wealth is in stocks, because my risk appetite is high even though I am old, right? So that depends on how much wealth you have created so far, and how much is your income presently, what are your expenditure commitments, right? If you are spending only a small percentage of your income on your day-to-day, I mean monthly expenses, you can afford to take risk. So 100 minus age is a standard, what shall I say, a yardstick, a standard norm, but it is not applicable to everyone. This rule can be broken. But generally, it is correct to say that in the early stage of your career, if you are young, I presume that there are many youngsters watching this program. If you are young, if you are in your early 30s or late 30s or even your 40s, well, this is the time when you should be investing money in stocks, because stocks outperform all other asset classes in the long run. There is no doubt about that. That is a lesson from financial history. In the short run, of course, there can be problems. There will be market corrections. There can be negative returns. There can be losses. But in the long run, if you invest in good quality stocks and stay invested, or if you invest through the mutual funds, through systematic investment plan, well, a phenomenal wealth can be created. So invest more in fixed income around retirement and invest in stocks and mutual funds for long-term wealth creation. That is a basic principle. Let's go to the next slide, please. This is again regarding, next one, please. This is again regarding the tax part, which I have very briefly explained, the tax implications of investment. Shall we go to the next one? Okay, so before I go into that, let me explain this. This is significant. It was one IAS officer in Trivandrum who asked me to introduce. When I explained this point, it was not part of the presentation which I made in Trivandrum, but a very senior IAS officer was attending. He's a very good investor also in Trivandrum, some 4 or 5 years back. When I explained this point, after the presentation, he came to me and told me, Vijay Kumar, you should explain this in some more detail, because there's a very valid point which even experts do not know, because that is a fundamental idea. That's why. So after that, I made it into a slide, and I'm explaining that. Now, why do we say that investment in equity is necessary for wealth creation? Why do we say equity or investment in stocks create long-term wealth? The reason is very simple. So I'm taking the normal investment avenues of ordinary people in India. Most people in India invest, those who have financial savings, those who have savings, they invest their money either in bank deposits or in small savings like public provident fund, national savings certificates, insurance, or in gold. That's a normal practice. Vast majority deposit the money, invest the money like that. Very few in equity. Now, when you are depositing money in a bank, you are lending money to the bank. The bank gives you, let us say, 5.5% interest. The bank lends at 9.5% interest. 4% is their interest margin, and that's the profit which they make. So you are lending money to the bank. When the bank makes profits, you don't share that profit. You get only the interest. For sharing the profit of the bank, you have to be a shareholder of the bank. So when you are depositing money in small savings, like PPF for instance, you are lending money to the government. And all governments, whether it is central government or state governments, have huge deficits. And Kerala is a classic example. In Kerala, we have made borrowing into a perfect art. I've been wondering, let me digress a little bit and tell you about this. I've been looking at the election manifestos of all political parties and different fronts, LDF, UDF, all those guys. They're talking about big, ambitious programs. പഴയൊരു സിനിമ സ്ഥാനാർത്ഥി സാറാമ്മ എന്നുള്ള സിനിമയുണ്ട്. അതിൽ അടൂർ ബാസി പാടിയിട്ടുള്ള പാട്ടുണ്ട്, തോട്ടിൻകരയിൽ വിമാനം ഇറങ്ങാൻ താവളം ഉണ്ടാക്കും, അതുപോലെയാണ് വലിയ അറേഞ്ച്മെന്റ്. Actually, the Kerala government is heading for a massive fiscal crisis, which in my opinion will aggravate by end 2022 or early 2023. We will face a massive crisis, unprecedented crisis within, let us say, next 1.5 years. And when you are borrowing recklessly like this, say, remember, even before COVID, COVID came only in March 2020. But in January and February 2020, before COVID, Kerala government has introduced restrictions on even passing 5 lakhs of bills in the treasury. Pre-COVID, we had 17,500 crore revenue deficit. But COVID has given an opportunity to the finance minister to borrow, because the government of India has raised the borrowing limit from 3.5% of the state domestic product to 5%. And therefore, they have now borrowed from the domestic market, from the bond market, the masala bonds in the international market. If I go into that, I will spend more time. That is not the topic of our presentation. So let me come back. When you are investing money in small savings, you are lending money to the government. And governments use this money for bridging the deficit in the government. In January and February, December, January, February, 3 months, state treasury in Kerala have attracted 3,500 crores of deposits. People were standing in queue in treasury for depositing money. And the queue was longer than the queue in Beverages Corporation. People depositing money because the government said they are going to reduce the interest rates. And the government got 3,500 crores of rupees as deposit in the treasury, Kerala government, 2 months back. So they are borrowing, in fact, at 8.5%. And this money is used for government's expenditure. Can it create wealth? The government borrows 3,500 crores rupees through treasury deposits and use the money for distribution of kits, even to people who have 1 lakh income a month. It cannot create wealth. That is financial disaster. But then that is the way public finances are being managed. Now, if you are investing money in gold, gold being a scarce item, gold can appreciate in value and give you very good return. And we know gold is historically, in India particularly, not in the developed world. In the developed world, it has not been a highly performing asset class. That is why investors in the developed world don't invest in gold. But in India, the investment has been doing extraordinarily well because of depreciation in currency. In 1980, gold was $800 a troy ounce. Now it is $1,700 a troy ounce. So what does it mean? It means during the last 41 years, gold has only doubled in value. 1980, $800. 2021, $1,700. It has just doubled. But in India, it has multiplied 13 times, 14 times, because rupee depreciated from 8 rupees to a dollar in 1980 to 72 rupees to a dollar now. So the 900% increase in the price of gold, the value of gold, because of currency depreciation. We must understand that. So when you invest money in bank deposits, you are lending money to the government, to the banks. When you are lending money, depositing money in small savings, you are lending money to government. When you are buying gold, your investment appreciates because it is a scarce commodity, but it is an unproductive asset. All of us will be having gold ornaments in the bank lockers. Last 5 years, 10 years, 15 years, 20 years. It will be in the bank lockers. And the bank locker, it is an idle asset. It is not creating any wealth. It is not used for productive purposes. But when you are investing money in equity, when you are buying the shares of a company, or when you apply for the IPO, when a company makes an IPO, large number of IPOs are coming now. Companies raise this money. Many of Kerala companies have raised money. VGuard, for instance, raised money through IPO. Created a lot of, Kochau Titlapalli has created a lot of wealth for investors like you and me. I have invested in VGuard. The returns has been fabulous. So when entrepreneurs like Kochau raise money from the public, and when we put the money in the shares, this money is invested in directly productive business activity. And when the company does well, the share price goes up, investors will benefit. This is the difference between depositing money in a bank, small savings, gold, and investing in equity or buying ownership of a company. When the company grows, wealth is created. And when the company is great company, like Infosys or HCL Tech or Wipro or Tata Communications or Tata Communications or TCS or HDFC Bank or Kotak Bank or HDFC or Larsen & Toubro or Reliance or Bharati Airtel, whatever. phenomenal wealth is created. But the risk, there is a risk. The risk is company's performance. If you invest in a poor company and the company does very badly, you lose your entire money. That's the risk. If you put money in bank deposit, you will not lose everything because there is a guarantee, insurance. But if your investment is in a poor company or a company which you thought will do well but did not do well, you lose all your money. Mr. Rupesh Rajagopal, who will be speaking after me, will tell you more about that. So that it is very important that if you are investing in stocks directly, you should have the expertise for that. You have to have the expertise for that. Expertise to identify good companies, expertise to read the balance sheet, analyze balance sheet and draw conclusions out of that. Expertise to look into the track record of companies, the promoters, the quality of management, etc. And then invest in stocks. If you don't have that expertise, you can invest to the mutual funds. Leave this decision making to the fund managers. Fund managers are competent people, most of them. So this is why equity creates wealth. I took some time to explain that because this is economic logic. This is rational economics. Let's go into the next one, please. Next slide. So I explained why equity and why wealth creation through equity. Next one, please. Has the slide got stuck? Well, equity means all other asset classes. Just sorry. Now you have to understand this point. This already I explained. Financial history tells us that stocks outperform all other asset classes in the long run. In India, it has given 15% average during the last 40 years, but this 15% is the average. In certain years, it will be more than 50, can be 20% and 25%. Last year, from March 2020 to March 2021, the return is 100%, but that is an exceptional, very, very rare thing. In certain years, the return may be 4%, 5%. In certain years, it may be 0. And once in 4 or 5 years, it can be even negative. But in the long run, if you stay invested as an investor in the long run, it can give you phenomenal returns. As I have explained, it has multiplied more than 500 times in the last 42 years. After the initiation of liberalization in India in 1991, India's GDP grew 10 times and the Sensex multiplied 50 times. In 1991, Sensex was 1,000. Now it is 50,000. Next one, please. Now the magic behind, I told you about 14%, 15%. There's a huge difference between 8% and 12%, right? You must be knowing this power of compounding, therefore I don't know how to explain to this. But then this simple example will make it very clear. You're investing 1,000 rupees every month for 30 years. It will grow to 10 lakhs if the return is 6%. But if the return is 10%, it will grow to 22 lakhs. The return is 15%, it will go to, I have not put the number here, 82 lakhs. The difference between 6 and 10 is huge. The 6 and 10 is only 55% difference, but 10 and 22 is just more than doubling. Similarly, here there will be huge return. So it can give, stocks can give and mutual funds can give good return. 15% is the historical experience, but expect only 10%. Even 10% now with some tax benefits like long-term capital gains exemption. It is very good. We'll go to the next one, please. So this is something which you know, and I already explained. This is the income tax. This is the first. I have not taken the new income tax which was introduced by Nirmala Sitharaman last year, with which you are familiar. Income tax, new income tax regime without exemption. This is the income tax regime with exemptions, the old one. Next one, please. For some people, the new one is better. So the tax part, we know dividend, formerly dividend was completely exempt from tax. But now there are large number of investors in India who are getting crores of rupees as dividend. Therefore, income, it is added to your income and taxed as per your tax slab. Long-term capital gains, that is the gains by selling shares, by holding it for 1 year. 1 year is a long term. For property, it is 3 years. For stocks and mutual funds, it is 1 year. Long-term capital gains are tax-free up to 1 lakh. Now, this can be very smartly used. It can be very smartly used. For example, if there are 4 demat accounts in a family, in my family, I have 4 demat accounts of myself, my wife, my 2 daughters. I mean, sons-in-law also have their own demat accounts. And now even my 2-year-old grandson also has an account. So let us say I'm managing 4 accounts, right? Of my wife, myself, and my 2 daughters. Then I can take 1 lakh long-term capital gains from all these 4. So in that case, my family's long-term capital gains will be 4 lakh. No tax implication on that. So there are innovative ways of managing long-term capital gains. Long-term capital gains beyond 1 lakh, again, even now, it is taxed only at 10%. So for a person in the high tax bracket, let's say 30% tax bracket plus surcharge and all that, even if his long-term capital gain is more than 1 lakh, he pays only 10%. He or she pays only 10%. Short-term capital gains are taxed at 15%. Next one, please. Same is applicable to mutual funds also. Same as applicable to equity shares. Dividends tax according to tax slab. Long-term taxable capital gains exempted up to 1 lakh. Beyond 1 lakh taxed at 10%. Short-term at 15%. For non-equity fund debt funds, of course, it is different. Long-term is defined as 36 months, unlike 1 year here. Now, 20% indexation benefits. These are things with which you are familiar. Therefore, I am not explaining that to members of Chartered Accounting Institute. Let's go to the next one, please. Now, in India, there are big changes happening in the Indian economy now. Very big changes happening. During the 1950s, 60s, and 70s, in the first 3 decades following India's independence, our GDP growth rate was 3.5%. Population growth was 2.3%. It was called the Hindu growth rate by the economist Raj Krishna, one of the lowest growth rates among the developing economies. Per capita income was growing at 1.2%. Savings were very, very poor. Corporates were not making money. Tax was very high. You know, the income tax in 1973 was 97.75%. Income tax, surcharge, and all that. So if you make 100 rupees, if you are in that high tax bracket, you have to pay 97.75%, close to 98 if you take income tax and wealth tax. So actually, I would say the government of India, in government of India's fiscal policy, played a very important role in encouraging black money, unaccounted money in India. If you are asked to pay 97% of your income as tax, and if you are allowed to put only 3% out of the 100 rupees that you make in your pocket, well, people will find innovative ways of evading tax, and experts will help them in doing that. So, but now situation is very different. The economy is growing at a much faster rate. Savings are higher. Corporate tax also is very low. Companies are making profit. There are no control. Indira Gandhi introduced control on dividend. That is, the government of India will decide how much dividend a company should pay. Dividend control, right? Price control on companies manufacturing soaps and shampoos. That was the old economics of 1970s. But now, thanks to Narasimha Rao and Manmohan Singh, we introduced liberalization in 1991, which is being followed by all the governments that came to power following 1991. And therefore, the economy is growing. Companies are making profits. Some of our companies are world-class companies. World-class companies globally. I felt very proud. In 2006, I got an opportunity to visit Hungary and talk in the Central European University. So the morning of my first visit to the Central European University, I was taken. My host, they took me to the Dean of Management in Central European University, Budapest in Hungary. And when I was introduced as Professor Vijay Kumar from India, he said, oh, You are from the land of Infosys. India meant Infosys to him, right? Because Infosys was at that point of time one of the great wealth creators and a globally recognized company, not only for the money which they were, the profits which they were making and the stock prices shooting up, not only for that, but also for corporate governance, ethical behavior. So Indian companies have started making money, so there are opportunities. So after liberalization in 1991, India's GDP grew 10 times and Sensex multiplied 50 times. Foreign institutional investors and HNIs have benefited substantially. This is one point which I want to share with you. So great companies. As an investor in HDFC Bank, one of my favorite shares, HDFC Bank. That bank has given phenomenal return. Do you know, during the last 10 years, the investment in HDFC Bank has multiplied 10 times. 10 times, 1000%. If you have invested 10 lakhs, your value of investment is now 1 crore. But do you know who benefited? Only a small group of investors in India, mutual fund investors in India also. But 74% of the equity of HDFC Bank is held by foreigners, foreign institutional investors, foreign wealth funds, sovereign wealth funds, foreign pension funds, Stanford University Endowment Fund. They have been smart enough to identify such great companies like HDFC Bank, TCS, Larsen & Toubro, Bharti Airtel, Reliance, and invested money, whereas Indians did not. So when these companies created wealth, they locked all the way to the bank. Only a small minority of India benefited from that. So if this growth is to be inclusive, all of us can benefit from this by participating in the capital market. So that is one of the reasons why the Ministry of Corporate Affairs is also encouraging programs like this. So vast majority of Indian investors did not benefit because they did not invest. They have to invest. That is why we have all these programs going on the TV, mutual fund sahi hai, and also telling you not to invest in based on tips, something like that. Okay, next one, please. The current market scenario, existing investors will be keen to know something about this. Presently, we have a bull run in the stock market. And remember, it is not a bull run confined to India. In India, during the last 1 year, from 23rd March to 23rd March, that when the globe, when COVID-19 was declared as the pandemic, stock markets crashed, circuit down. This can happen in the market, you know. And let me tell you from my experience in the market during the last 36 years, I have learned the tragedy is when you should be buying stocks. The best time to buy is when there is blood on the streets. That is a saying. Blood on the streets means not literally blood on the streets. When there is problem, when there is crisis, when there is fear, everyone will be selling. The crowd will be selling. That is when you should be putting your money in stocks, because the prices will be at rock bottom levels. Buy when there is fear in the market. From my experience, I am telling you, in 1984, when I entered the market, a few months after that, Indira Gandhi was assassinated. Not because I entered the market. So Indira Gandhi was assassinated. After that, we had the Khalistan problem. Then the politics around Babri Masjid. Then the assassination of Rajiv Gandhi. Babri Masjid demolition. Communal riots. The Kargil war. The tsunami. The earthquakes. The severe drought, the floods, all those things, political instability, coalition governments, all these things. What happened? I saw the Sensex appreciate from 430 to 50,000 now, going through all these ups and downs. So whenever there is a down, those who bought made money, because the long-term trend is a long run, but the trend is not a cyclical trend. It is characterized by ups and downs in the market. So Nifty recovered 100% in the last 1 year, but this is an exception, not the rule. And what the markets, as I told you, This is a global rally, and this rally is driven by huge liquidity. We never had this kind of humongous liquidity creation by the leading central banks of the world. You must be familiar with quantitative easing. All the central banks are printing money, quantitative easing, buying securities in the market by printing money. More than $10 trillion. Remember, India's GDP is more than 2 trillion. So 5 times the size of India's GDP has been printed by the leading central banks of the world. The Fed, the European Central Bank, Bank of England, Bank of Japan, have created more than $10 trillion, and this money has been injected into the global financial system, and therefore interest rates have crashed to historical lows. $16 trillion invested in AAA rated bonds globally are now yielding negative returns because of money chasing asset classes. So we have a historically unprecedented rare situation where ample liquidity is available because of quantitative easing by the leading central banks. Interest rates are at historically low levels. We never had this kind of interest rates, according to a study by London School of Economics during the last 2,500 years. And there is a retail stock rush now, the Robin Hood phenomenon. People are working from home. You can trade from home, trade from anywhere, buy and sell securities from anywhere, because the technology platforms are available. And there is sharp recovery in economic growth and corporate earnings now. Globally, because after the vaccine has been discovered, there is unlocking, and corporate, after the 5% GDP contraction in 2020, in 2021, global GDP is expected to expand by 5.5%, and India's GDP is expected to expand by 11.5%. So the markets are driven by these factors, 4 factors. The valuations are high in India. Historically, actually, there are many yardsticks for valuation. Ranjit, how much time do I have? Ranjit?
5 to 10 minutes is fine, sir.
Okay, fine. I will conclude in 5 minutes. So valuations are high. There are many metrics of valuations, but then the normal valuation metrics are the price earning multiple, price to book value, market cap to GDP ratio, etc. I'm not going to the technical details. Going by all norms of valuations are high. And when the valuations are high, so for example, take PE ratio. The historical PE ratio in India is around 15. Now the PE ratio is, forward PE is about 22, 23. So it is 50% more. Price to book, it is more. Market cap to GDP is more than 100% now. But then this is a new normal where ample liquidity is available and interest rates are historically at very, very low levels. In the developed world, as I told you, around $16 trillion are invested in bonds from which returns are negative. So this is a very new normal, and such new normals you can have a higher valuation. So valuations are high, and therefore market is vulnerable. At high valuations, markets are vulnerable to sharp corrections. Therefore, there can be sharp corrections going forward. You can expect corrections. It can be 5%, it can be 10%. And if there is some very bad news, for example, the bond yield, the US 10-year bond yield, which is a very important, I would say that is the most important macroeconomic indicator in the world. One indicator which can move markets, all markets, not just equity market. It can move equity markets, bond market, currency markets all over the world. So if the 10-year bond yield in the US goes above 2% in the next couple of months, there can be big corrections in the market. But then all corrections will be opportunities to buy, provided you are buying good quality stocks. Next one, please. That's the last slide. With that, I'll conclude. So India growth story. I told you we have been growing impressively. Indian economy, even though during the last 1 year, all the economy is contracted. Indian economy grew by 6.7% during the last 27 years after liberalization, right? Therefore, you look at these figures. India took 60 years to become a 1 trillion economy. From 1947 to 2007, we took 60 years. But the next 1 trillion, 2 trillion came in 8 years, in 2015. we would have become a 5 trillion economy, which the Prime Minister is talking about by 2024-25. That was the target of the Prime Minister, but then COVID intervened and we are not likely to reach that target. Not likely, we will not reach the target in 2025. But then if we make an impressive recovery post-COVID, we can reach a 5 trillion target. That certainly it will be reached, but it will be 2 years because we will be losing time because of COVID. So what is going to happen is when we become a 5 trillion economy, the market cap also will be 5 trillion compared to 2 trillion now, the market cap of Indian companies. So what we are likely to witness going forward, I'm not talking about 5 years, I'm talking about 10 years, 15 years, 20 years. Phenomenal wealth will be created through the stock market. Phenomenal wealth. If you look at companies, you will find that. The net profit of companies like Maruti, Reliance, Larsen & Toubro, the net profit now is more than the sales turnover in 1991. The net profit now is more than the sales turnover in 1991. Similarly, for many companies now, who are having, let us say, a particular amount of turnover, that will be their net profits from 15 years, 10 years, 15 years from now. So it is going to be phenomenal wealth creation, but it is not going to be a smooth ride along a straight line. It will be a roller coaster ride. But then for long-term investors, you should enjoy the roller coaster ride. There is going to be phenomenal wealth creation, and participate in this wealth creation. As I told you, foreigners who invested in India's great companies have made a lot of money. Only a small minority of Indians have invested. That is why the government of India also, Ministry of Corporate Affairs, is appealing to Indians through programs like this to invest in the market, ordinary people to invest in the market directly if they have expertise, but only a small minority have the expertise. But if you don't have the expertise, invest through the mutual funds, ideally through the systematic investment plans, and make money. Thank you very much for giving me a patient listening. It is 5:13. So I think I have stuck to the timeline given by Ranjit. Well, I used to teach in college. I used to teach time management also. Therefore, I should stick to the time. Thank you all the participants for this very good hearing that you gave me. Thank you very much.
Thank you, Dr. Vijay Kumar, for that wonderful discourse. It was very enlightening listening to you.
Thank you.
Our chief guest for the day, Sri G.C. Yadav sir, a Registrar of Companies, Kerala and Lakshadweep, has joined us. May I call upon our chairman, C. Ranjit Arwariya, to welcome him.
Thank you, Deepa. As rightly how you said, listening to Vijay Kumar sir was a real treat. You know, the way in which he conveyed his points in a very simple manner, with a lot of examples of certain investors and in the stories through which they turned around the market or the habit of investing itself is truly great to listen to. Thank you so much once again, Vijay Kumar sir, for the great share of your knowledge and the expertise. Sir. We have here with us our esteemed chief guest, if I might call him, our very own Yadav ji. Yadav sir has been a very brotherly figure for the Ernakulam branch and for all the chartered accountants. For any chartered accountants who wish to see or to have an appointment with Yadav sir, it is just that you have to walk into his office, and if he is there, irrespective of how busy he is sure to grant us appointment on a priority basis. The the intention of, I was sharing with Yadav sir and with Vijay Kumar sir, intention of doing investor awareness sessions from this year onwards, or probably this year, is to bring in a mass awareness, especially among the seniors and juniors equally. Where for the seniors, as you might know, many of our senior members or per se in public as well, a lot of investments are there, or a lot of liquidity is there, but hardly 5% of it goes to the capital market or to the share market, wherein there's a lot of myth behind, wherein the risk factor is projected much higher than the benefit factor. And so is the intention that I would like to, or we would like to personally bring in a lot of awareness and a lot of push to help and understand that there's a lot of advantages and benefits, and it is not as risky as we think. and also to the interest of the younger members or the younger generation and to the public at large to promote the awareness on bringing in safe and good investments into the capital market and share market, where we also believe that this is also equally part of nation building. A lot of these, especially at this time, a lot of these funds invested into the infrastructure development, lot into the to the pharma sector, a lot into the software sector. All of it, a majority of them are very, very safe and very, very attractive investments. But nonetheless, the risk is the thing that is hyped and made aware to the public more than the benefits and advantages. And I also thank Geojit Financial Services for the support that they've come forward with for this year. As I said, that we would like to go into a mass scale to bring in this kind of an awareness to the general public and to our members at large as well. With these few little words, let me once again take this good opportunity to welcome our very own Yadav sir to this session on investor awareness. Welcome to you, Yadav sir. We also have our next speaker, Rupesh Rajagopal sir, patiently hearing from the first session onwards. Good to see you, sir, and a very, very warm welcome to you once again. With these few words, I have my good managing committee members here as well. A very, very hearty welcome to each one of you and to the participants for the patient hearing and for your patient attendance. We have one more great session coming ahead after the good words of wisdom that we are eagerly waiting to hear from Yadav sir. With these few words, let me go back and hand it over to Deepa Varghese again.
Thank you, Chairman. As you all know, J.C. Yadav sir is the Registrar of Companies Kerala and Lakshadweep, and he has assumed that position from November 2018. He is a BSc LLB from Allahabad University, Uttar Pradesh. Before assuming charge as a Registrar of Companies Kerala and Lakshadweep, he was practicing as an advocate in civil court, had been an AROC for West Bengal, Kolkata, an official liquidator, Orissa, attached to the High Court of Orissa, official liquidator, Bihar, attached to the High Court of Bihar. He was also the ROC cum official liquidator for Northeast, and he is also taken charge as the official liquidator Karnataka, attached to the High Court of Karnataka, before assuming charge as the Registrar of Companies Kerala and Lakshadweep. Sir, we are waiting anxiously to hear from you, sir.
Thank you, madam. At the very outset, I would like to extend my apology for becoming delayed, and as if I have missed very valuable session, but still let the program should go. And I would like to thank Mr. Warrior, Chairman of the Kochi chapter, Madam Deepa, all learned speakers, and members of the Kochi chapter, Institute of Chartered Accountant Kochi chapter. This investor awareness program is driven by the Ministry of Corporate Affairs, and the basic motto of this program is that the investor should know about the company, about the business of company, about the performance of company. Then that task is to be performed by different partners like Institute of Chartered Accountant, Cost Accountant, Company Secretary, and particularly Institute of Chartered Accountant is performing this task well. And frequently and very prominent speakers are coming. In Kerala, the peoples are investing, focusing on gold investment. Now this is your responsibility to divert this mentality, and they should invest in capital investment. So with this, I will conclude and thank you all. And again, apologies for becoming delayed. And let the remaining should continue. And I am here, and now I will be connected. Thank you all.
Thank you so much, sir, for that. It's absolutely no problem. We have no problem waiting for you. We understand how busy you are. Moving on to the second topic for the day, it's a pleasure to introduce CA Rupee. He's a fellow member, a chartered accountant who qualified in 1997 and is presently working as the Group Associate Vice President and Division Head, Branch Banking Audits for DCB Bank. Prior to this, he was a Deputy Vice President for IndusInd Bank from 2009 to 2014. And he was also the Senior Manager at ICICI Bank from 2003 to 2009. He has been a trainer for the bank on audit compliance, KYC, and AML guidelines. He is specialized in internal audits, concurrent audits, business intelligence, and analytics. He is a regular speaker at various B schools and knowledge forums. With these words, sir, may I hand over the mic to you, CA Rupee.
Thank you, Deepa. At the outset, thank you, Ranjit and Deepa and the vibrant Kochi Managing Committee team for giving this opportunity. All the best. You have a whole year left. I'm sure you guys would do wonders here. It was a real pleasure listening to Vijay Kumar sir. This is the second time I'm listening to him, but last time I think he was in KMA as a speaker, and it's always really a moment to cherish listening to experts like him. So Ranjit, I would like to share the presentation. So can I get the rights to do that?
Absolutely, absolutely.
You'll have to make me a co-host, I think, to share it. It's done, Ranjit. Deepa, can I get the...
Yeah, 1 second. Raju, can you please confirm?
Sir is the presenter.
Sir is the presenter. Okay, so it's done.
Okay. Thank you. Yeah. So before I move on to the session, I would also like to thank Yadavji, the Registrar of Companies, who's here. I also had the privilege. He was the chief guest last time I did this session in 2019 in the institute. So thank you, sir. Thank you for being there in spite of your busy schedule. So let's move on to the session. Are you able to see the screen? I mean, Deepa, is it clear?
Yes, it's very clear. Please go ahead.
Perfect. Thank you. I think Vijay Kumar sir has covered it very clearly in terms of different asset classes and things. So, my first few slides, which talk about the basic elementary thing, I think I'll make a run through because, he has already covered that in detail. So, I would like to take you through this, basically the discussion points that why people should invest, common types of investments, when do we start investing. I also cover a few areas like real returns on investments. What are the risks in investing? What common mistakes people make in investing? Because as a banker, in and out every day, we come across a lot of people who come and ask us opinion about investments, investment decisions, and they keep telling us about what happened, where they were successful and where they failed. So, just, I've just brought in some inputs from there. So, the basic human life cycle divided into 3 phases. The phase 1, which has the education, the phase 2, which I think we have already covered in detail, which carries all your key stages of life like marriage, children, housing, your child education, child marriage, and all that. So this is how generally, and the phase 3 is where the retirement happens. So generally, this is the human life cycle divided into 3 phases, and the key phase where your earning years of considering the age of say a 60, you will have something like 30 to 30 40 years where you will be in phase 2 where you actually earn money. And of course, we have come through the life cycle, so I'll skip this. Now, the only way to fulfill goals and be financially stable is to have savings and investing. Now, here, I would like to put across a thought like this, because income minus expenses is your savings. This is a normal understanding that everybody has. At this rate, if you see today, how many of us will be able to invest? Because the moment you get your paycheck, most of the cases, your expenses take away 90%, 95%, and you're hardly left with savings. This happens to any normal salaried individual or self-employed individual, unless you are so well placed and so well paid or whatever. So I would put it like this: income minus savings is your expenses. So if you have a disciplined way to create some percentage of your income, depending on what you are able to afford, what you are able to put aside, in your basket, keep one portion of your amount as savings, and the rest you should have your expenses. So this kind of personal budgeting, while most of us are chartered accountants, we are experts in terms of budgeting and I find that the last people who plan for themselves are the chartered. We do it fantastically well for our clients, but for ourselves, we normally don't do it. So, I can see that the last set of audience is our own members. So please, put aside one portion of your income as savings and then decide on your expenses. Now, 2 things that we need to keep watch on is the inflation and the taxes. Of course, inflation and taxes has already been covered in detail. Just to bring a one line on it, inflation is nothing but that your purchasing power has come down over the years because of increase in prices of goods and services over a period of time. Now, we all understand this basic concept. Now, looking at India, if you see, the inflation rate has moved average at say 6.03% from 2012 to 2021. Now, this is a statistics taken from the Economics Ministry of Statistics. So we had the highest in November and 1.54 in June 2017. So I was just rechecking on when I reworked on the presentation to see if at any point of time whether the high and low has changed, and I think it remains the same. So more or less there is some kind of a track where we are heading, and we're happy with the the government initiatives on that. Now, what is a real nominal return? Let us understand the nominal return first. You get an FD at say 8% today. So that is your nominal return. That is the return that is given or declared by a bank or an 8% bond or whatever investment model that you have. Any investment class, there is a nominal rate of. Now, a real rate of return is something that considers the inflation and the taxes. Now, for calculation purposes, we have brought in this formula. It says 1 plus nominal rate divided by 1 plus your inflation rate minus 1. Now, it might seem like very complex formula, but very, very simple. I'll show you in an example. Now, something that you have some asset class where you have a 9% and assuming that you have 5% inflation rate. So your real rate of return is 3.8%. While you would have thought and you would have felt happy that I'm investing something in 9% return, your actual rate of return is 3.8. I have not considered the tax factor here. So considering the tax factor also, and depending on the slab of the person, you would obviously see that there is a huge depreciation or a reduction in the kind of income that you are looking at. So let us cover a few basic products, because my presentation is scheduled more from a small investor angle. So I have brought in products which are available in the market and touching upon all of them, basically giving the features and the nature of these products. So a fixed deposit, if you see, it's a very common, very safe product. It creates a habit of investing. You can take a loan against your fixed deposit. Today, banks offer up to 90%, even 95% for certain cases. If you are a senior citizen, you have a higher rate of interest. You have interest payment options like cumulative, non-cumulative options. You have a DICGC guarantee of the government up to 5 lakhs for all your savings and deposits put together. This applies for all banks, all commercial banks. Because recently somewhere in the WhatsApp groups it was circulating saying that some private bank put a chapa on their FD receipt saying that the DICGC guarantee is up to this, and everybody said it's not safe to invest into that bank. So it's not like that. They were just being cautious about it, and they put it on a seal on that. But all banks, all commercial banks come under this scheme. You have a guaranteed return. Deposit is a very simple product. I don't have to explain much. Now, is it safe to keep your money in fixed deposit and savings bank alone? Now, let's look at the next slide. If you had 10 lakhs of rupees and 5 years later, your savings bank would show 8.5%, 8.5 lakhs, considering that the inflation is at say 6% and tax rate of say 30%. And after 10 years, it would be 7.2. So inflation and taxes eat away a good amount of your money. Similarly, in fixed deposits, a 10 lakhs invested after 10 years would be somewhere around 8.7 lakhs. So this is the normal 8 lakhs. It's not what happens. So I think it was covered saying that don't put all your eggs into one basket. Savings and fixed deposits is definitely required, but we call what it's called profiling exercise when we do it for an individual. We call it risk profiling. So depending on the risk appetite of the customer, depending on the risk appetite of the investor, you will have to decide what component of your money should lie in a savings account or a fixed deposit or any other asset class for that matter. Recurring deposits, again a small investment leading to bigger returns. It's just bit by bit. You can decide on what amount you can set aside every month. You have post office, you have banks offering this, you have a cumulative rate of return, and it gives you good returns after maybe 3 years, 5 years, depending on how many number of years that you want. Maximum is 10 as per regulation today. So this is also a good investment to look at. We have public provident fund. Now, what are the conditions or the benefits? This eligibility is there for all resident Indians. You have guaranteed returns. You have a lock-in for 15 years. You have a partial withdrawal available after the 50th year. You can take a loan against PPF from the 3rd to 6th year, subject to certain conditions. You can deposit up to 12 times in a year, and your contribution can be from 500 to 1.5 lakhs, and you have tax benefits under ATC. So PPF currently offers 7.1% interest today in the market. You have something called the National Pension System, where again the investment age or the entry age is between 18 to 60. It matures at the age of 60. You have a partial withdrawal up to 25% after 3 years, and it's a very low cost management fee of 0.01%. It's available in online as well as offline modes. Now there are two types of accounts here. You have a tier 1 account, which is a mandatory account when you open an NPS, and you also have a tier 2 account. Unless you have a tier 1 account, you can't open a tier 2 account. You have tax benefits for the tier 1 account under 80C, and you have there are no tax benefits for claiming under tier 2 unless you have a lock-in of 3 years. Here, the advantage is you have 4 different asset classes. You have an equity, a government bond, a corporate bond, and an alternative investment. Now, allocation to equities stand at something like, it's up to 75% for the corpus of the corpus, and it is valid up to the age of 50 years for the investor. 51 years onwards, you need to follow an active choice allocation, which is already fixed, where your equity component will reduce by 2.5%. So, this is how you can invest into NPS. You can stop me anywhere if you have any questions, or we can have a Q&A at the last. Ranjit, you can tell us where, if it is required, if there are any questions in the chat box, because I won't be able to access the chat box parallelly.
Sure,
No
sir.
problem. I'll be looking at the chat box. If there is anything, I'll let you know.
Sure. Thank you. Thank you.
Thank you. Yeah.
So next we have senior savings scheme. Here is another investment option. The minimum amount is 1,000. Maximum investment amount is 50 lakhs. You can, as a resident individual, you can invest. The tenor is 5 years. Interest payout is quarterly. Again, you have a tax benefit under section 80C. Tax on interest. The interest is taxable here. Withdrawal, the maturity amount is not taxed, but the interest is taxed if it exceeds more than 10,000 in a financial year. Automatically TDS applies. Sure, withdrawal is allowed after 1 year with applicable penalty. Now, senior citizens who are 60 years of age or who have applied for PRS can also apply for this. Retired defense personnel with minimum age of 50 years are allowed to invest. HUFs and NRIs cannot invest into this. We have covered the investment amount already. This is a government-sponsored scheme available at all banks and the post office. It offers a return of 7.4%. The last quarter, the return fixed by the government is 7.4. Nomination facilities available. Tax benefits are there. Maturity period of 5 years, extendable by another 3 years. So this is also a good product to invest in. So coming to RBI bonds. RBI comes out with bonds. We had the earlier one. It was not subscribed to the extent expected. Now we have a recent one which has come up with about 7.15% interest rate. Term is about 7 years. You can invest through cash, DD, or online. It's open for resident Indians across, and NRIs are not allowed to invest. Again, there is no maximum amount of investment here. The bonds cannot be transferred, and it's not a tradable or a collateral in the as a product. So we don't have that option. So RBI bond is also an investment to look at. 7.15% today, subject to inflation and taxes. Now here is where I have a different opinion from my earlier speaker, which I would like to state here. Gold has been an asset class which has successfully given returns over what? The last 1,000 years or more than that. Because gold has never ever come down. Of course, we had about 2013 to maybe 2015 where we had returns, but otherwise, gold generally gives fantastic returns for us. So gold should be part of your asset class, but should not be only your asset class. Yadav was saying that in Indian scenario, if you see, the houses are hoarded with gold, and people invest a lot into it, especially jewelry. So we have a lot of other modes of investment. You have ETFs, you have bonds, You have multiple options to invest into gold, not just jewelry. Because the more you invest into physical gold, the more is the import, and it has impact on your overall budget of the bank of the country. But gold definitely is an asset class to have because it gives you fantastic returns. The last year, if you see 2020, gold gave returns close to something like 28%. So it outperformed the other classes in terms of returns. Gold bond schemes. Again, this was something which I just mentioned upon. You can invest up to a minimum of 1 gram and a maximum of 4 kgs per investor. So here, if the entity is like a trust or university, then you have a maximum limit of up to 20 kgs. The maturity period is 8 years. You have a 2.5% annual interest paid twice a year on the nominal value, and it's open to resident, individuals, trust, HUF, you mentioned all the entities. This is also a good mode of investment. When you look at gold bond, we have seen PPF and other investments. Now coming to stocks and shares. I think this is already very, very well, very lucidly saying that how to invest into the market and what you need to take care. I fully vouch his views here because he has been very clearly covering it. Investing in stocks is not everybody's cup of tea, but you trust me, it's one of the best investments if you look at long term, because it can give you very steady returns if you are ready to stay invested for a long term. When you say long term, people obviously, when I give this opinion, people come back saying, what do you mean by long term? Is it 3 years, 5 years, 10 years? So the longer you stay, the better it is. As he rightly put across the example of Infosys, somebody holding, you know, 1,000 rupee or 100 rupee share in 1993, holding something close to 14 crores of money here. We have a similar story for Wipro. And somebody who invested into Wipro in 1980s for something like 2007, he was making somewhere close to 3.5 crores of money. So it always gives you a better return over a long period of time. Now the critical part here is you stay focused on the price, where you want to invest, what do you want to invest. Practice before you jump in. You cannot suddenly overnight become a what do you call a trader, handling secondary market, to invest, buy and sell on a day, make profits. There are experts who are doing. Everybody can't. You can never time a market. You need a lot of expertise to understand which company you are investing into, or what time you should invest into, what price you should buy, all that. Now just look at the Sensex milestone journey, which our learned speaker was talking about. It moved from 100 in 1979 to 50,000 in 2021. Now look at the movement of the market. Just think, possibly, I was probably 3 or 4 years old when it was 100. So today the market is at 50,000. See the way the markets have grown. How many people, how many of us who are sitting here would have invested and taken advantage of it? Now this is one fantastic opportunity to invest. I would say equity has to be a fairly good component of any investor's portfolio. Now, generally in shares and stock, what happens is there is a lot of optimism which happens. You get excited, you start buying shares, you see that grow by 2 rupees, 1 rupee, 5 rupees, then you have an excitement, you have a thrill, then you start buying more, and it reaches a euphoria, and then suddenly the market crashes or the market goes down. Market is a very complex factor. It's not driven by 1 or 2 factors. It's quite complex. So the market goes down, then you have anxiety, depression, panic. People start selling, then they say, see, this is not my ball game. I don't want to be an investor in the market. But people who have stayed in the market for long will always vouch that this is one of the best investments. it's like, being a physics student, I'll always say it's like a sine wave. If you see that, it's like a sine wave. It goes up and down. It goes up and down. We'll see one more slide where I'll show that. So, this is one of the best investments made. Now, I'll touch upon mutual funds, which has always been a favorite product for me, a favorite investment asset class in the markets. So what is a mutual fund? Investors, there is a fund manager, an expert like our Jigman sir who will handle the securities for us, and he gives down a return. So you are giving money to a set of fund managers who are experts on the job, who knows which company to invest. They know when to buy Infosys or when to sell Infosys. They know when to buy a Wipro or when to sell it. They know when a price would increase and for what reasons. It is very difficult for a common investor to understand this. That is where a mutual fund assumes a lot of importance, because unlike a normal share trade, buying and selling, or an investing, this is a case where you have combined set of stocks and shares brought together into a class called mutual, where it could average out and give you a better return. So we have experts working on it. We have securities and to have a return. So, on an average, 14-15% over the last few years, we have seen mutual funds give very steadily if you are invested, in a good fund. Now we'll go through what are required to see what is a fund, how do we invest, what should we look at when we look at a mutual. So these are the few areas why we should invest. I've already covered it. Expertise is there, the diversification is there, liquidity is there, and you also have the convenience. You don't have to sit and learn about each company. You have a better returns, almost similar to an equity investment directly. They're safe, transparent. So there are different classes of mutual funds. I'm not going to cover them in detail. We have debt, we have equity, we have hybrid. Now we also have thematic funds, which I have come up, the last decade, and we have a lot of different types of mutual funds which are there for various tenures. You have mutual funds where you can invest from, say, starting from a day to years together. If you look at this graph, this is the graph that I was talking about, the risk return graph. So here, equity, if you see, the index funds are the lowest in terms of risk. Then you have arbitrage funds, balanced funds, diversified funds, and sectoral funds. You see, the low to high, the risk moves up, and it actually goes from the low to the high. According to the risk increase, you have the returns as well. Similarly, for debt funds, you start from a liquid fund, an ultra short term, a long short term funds, a gilt or a bond fund, to a hybrid or an MIP fund. Generally, the hybrid or MIP funds have a lock-in period of something like, say, 3 years, 5 years. These are there. So if you map your needs to the mutual funds, it is something like this. If you want to park your surplus money, you look at liquid funds. It's more like you hold a current account in a bank. Being a banker myself, I have suggested a lot of people to hold funds in liquid funds because current doesn't fetch you enough. Doesn't fetch you interest at all. Short-term savings, you look at a debt fund, and a wealth creation, equity funds. So if you were to map your horizon, it's like this: 1 day to 3 months at a liquid fund, a 1 day to 2 years, you look at a debt fund or a bond fund, 2 to 3 years, you can look at a conservative hybrid fund or an asset allocation fund. 3 to 5 years, you can look at large cap funds, balanced funds, where you have debt and equity component put together, or even large cap funds. And more than that, you can look at diversified equity funds. So This is timing, mapping your horizon and mapping your investment goals in a mutual fund market. This is only for illustrative purpose, where you have a asset allocation for investor profile with 20% stock, 55% bond, and 25% in cash. When I say cash, it means the money that you hold liquid in your bank. For a conservative investor, to a very aggressive investor, where we call it 80% into stock, 50% bonds, and 5% cash. So this is purely dependent on an individual's risk appetite. While we can put any number of illustrations and models, I had a customer who was 85 years of age, who would invest only in equities. You tell him, sir, your age is high, your thumb rule of, your age, calculations and all that. He'll say nothing. Don't give me all this gyan. I want to invest only into equities. And he was a good investor. He was making money, and he's still doing really well. His portfolio is now being handled by his children, but he was a very aggressive investor. So it purely depends on the individual persons who want to invest. It's purely on a risk profile, and a risk profiling is a huge exercise to understand what is right for that particular individual. So it takes an expert like a banker or a stock trader or a broker who's a good expert for you, a mutual fund company, somebody who can understand the profiling exercise, who can do this for you. Here is why long term, I am supporting the views from my earlier learned speaker. The investing in long term, you see the cycle, it goes like a sine wave, as I told you. But if you see, it grows steadily up. It gives you a good return if you stay invested for a long time. But it needs a lot of patience, because you cannot look at your portfolio every day morning. I know people who get up every day morning, the first ritual is to open their demat account or trading account and see how much profit I have made. It really doesn't work like that. You stay invested. It's shut, close, open it only after a particular time frame where you want to review it. You stay invested patiently and wait for it. Now, the best way of investing is to have a systematic investment. Whether it is mutual fund, whether it is equity, whether any investment class, if you say, it should be systematic. Invest regularly a fixed sum of money. Have a disciplined approach for investments. You get the benefit of power of compounding, which was already shown. I'll show a couple of slides on that. And we also have something called a rupee cost averaging. And starting early has all the advantages. All those younger listeners whom we have here today, who are in their 20s, please start investing right now. Today, whatever surplus that you have, please start investing. You will see this. Maybe by the time you are, 50, maybe 30 years into or 35 years in the future, I don't know how many of us would be there, but you will definitely thank us for this advice, saying that start investment early. Because this is wisdom which has been carried on for generations. Many times we don't listen. Even we have not listened for years, but it has its advantages. And now when we are matured enough to understand, we already feel that we have lost a large amount of time losing it. See, rupee cost averaging. How does rupee cost averaging work? Today you are buying, say, 10,000 units of a particular mutual fund, okay, and the NAV is 10 rupees. So you have advantage here. So you get 1,000 units. Again, next investment, again 10,000 rupees. NAV is 10.5. You get 952 units. So you look at that model of investment. If your NAV is growing in a rising market, you have an NAV of something like, a 60,000 rupees invested, you hold something like 4,643 units. in a falling market, you hold something like 7,700 units. If the markets are volatile, still you have 5,600 odd units. Now see that if you keep investing on a steady scale, the rupee cost averaging helps you have more number of units, more number of shares, whatever it is with you, to with what you have invested than what you would have done as a lump sum. Possibly if you had invested this 60,000 in the first year, you would have had a very different scenario. Of course, the example here is only 10 rupees, but in a very volatile scenario, it would have been way different. So this is just a graph to show how averaging works. See, if it increases the market, you get more number of units, and then again you get the market rising, you have a lower number of units. So this keeps averaging for you, giving you better number of units to hold on, and in the end of the day, better investment. Similarly, your power of compounding. Interest on interest. Power of compounding is nothing but interest on interest, or return accumulating over the return. So if you invest, say, 1,000 rupees over 20 years, at end of 10 years, you have a 2x figure. The end of, say, 15 years, you have something like a 3x figure, and the end of 20 years, you have something like a 4x figure. The numbers have gone up significantly because of compounding. So these are the advantages of investing. This is just an example to show you, say, a person who is investing at the age of 20 and at 35, if you compare, even if the investment amount is less for the person who is younger, and the investment tenure is larger for the person who is older, still the younger person has an advantage because of his age and starting early. This is because of the power of compounding. So we would put it like this. We normally summarize this saying that it's like a child's mark sheet. So if you invest 25 to 30 years, you have a first class. And if you are investing between 35 to 45, you have second class. Sorry. Between 45 to 55, you have a pass class. Greater than 55, even though we put it as here as fail, I'm sure we can find a lot of investors coming up here. So just to create that interest in the people, we say, please start investing early, and you will actually start seeing the returns. Now let us just touch upon a point here, which our learned speaker has already told us, and I would like to deliberate a couple of points here. Selecting a mutual fund, again, needs to have a study on the past performance. Okay, even if you're going to be investing into equity, you need to have that evaluation of the past performance. Look for consistency in that particular fund, how they have performed over the years, how do they rank in the overall. Today, unlike a decade or more back, today you have all the details updated in the AMFI site or any particular mutual fund company site, or different share company sites. You get all the details, all the history that is available for you to learn on. It is not always about NAV. It is not always about the share value. You can see that from the example that has given, if you see the NAV with the best growths have been recorded for the lowest and the highest yields. On January 1st, it's at 23, and the 7.44. If you look at the lowest, but you have other NAVs also, 19, 21, and 12. But you look at the growth overall from the illustration. This is from the AMFI side. So NAV or the share value is not just it. You should see what is the company, what is their background and history, how you evaluate their past performance? What is their consistency? You should always have urge to stay invested. The longer you stay, the more benefit that you get. So these are the basic things that you should think about it. This has already been covered. Diversification of your portfolio is very, very critical. Whatever be your asset allocation, you look at your own needs, your own investment horizons, what you need from say 2 years, 3 years, 5 years in the future. According to that, classify, invest into different asset classes. Now, basically, what are the risks that impact your investments? You have the market risk, you have interest risk, financial risk, purchasing power, reinvestment risk, political risk. Umpty number of risks are there. I'm not getting into the detail because that itself, the risk assessment is a different subject altogether. So just to touch upon that, you have multiple risks. So always look at asset classes which can give you steady returns, like equity, mutual funds. Always take an advice of an expert who can support you into investment. Okay, and that will lead you to a lot of benefits. Now that would be my last slide. Setting your financial goals, be clear on your investment horizons, investing on a very disciplined manner, them, never trying to time the markets. Impossible for any expert to do that. Never rely on shortcuts and returns. Kerala is known for it. We have had a lot of products, lot of assets which came out in short term. It says high returns, but the risk is extremely high. Many people have lost money too. And check the track record of whom you are investing with. Evaluate their past performances. Diversifying your investments, and don't get emotional over negative news in the market. And look for consistency in performance. And Vijay Kumar sir, thank you for one very important point which says stay invested, which he was very, very particularly emphasized. I'm going to add that also to this do's saying stay invested. That I think I cover my presentation there. I would be more than happy if there are any questions. So let's make your money grow for you. Thank you and happy investing. Ranjit, hope I am within the time limit.
Yes, very much within the time, Rupesh. Thank you so much. I was just checking the chat Q&A chat box. Right now, nobody has given any questions, so probably we'll wait for a minute or so, just in case somebody wanted to listen to your presentation and then shoot a question. Participants, in case any one of you wants to ask Vijay Kumar sir or Rupesh sir anything, please shoot a question to the Q&A chat box.
So I think I'm sure March is a busy month.
Yeah.
So people would definitely be busy with other things.
I guess. Chairman, there has been no question till now. Can we wind up the session?
Yeah, please go ahead. Please go ahead.
So, CA Rupesh, thank you so much for this wonderful session. It was a very simple and elegant one, and I just loved your do's and don'ts, especially the last line, stay invested. Thank you so much for coming over and talking to us and giving us those tips and explaining a lot of terms. I'm sure everybody enjoyed the session. And thank you so much, Dr. Vijay Kumar sir. Yours was also a wonderful session. We hope to see you all again very soon. Stay connected.
Thank you, Rupesh ji. Thank you. See you soon. Thank you, sir.
Thank you, Ranjit. Thank you, Deepa. Thank you all. Bye-bye. Take care.
Bye-bye.